Ben Graham begins Chapter 5 by reminding the defensive investor why common stocks still deserve a place in a conservative portfolio. Back in 1949, he had to argue the point because stocks were widely seen as speculative. By the late 1960s and early 1970s, the opposite was true. Stocks had gone up so much that many people assumed they were safe. Graham's message is simple and balanced. Stocks have two real advantages over bonds. They can protect, at least partly, against inflation. And they tend to offer higher average returns because of dividends plus reinvested profits. But those advantages disappear if you pay too high a price for the shares. So how should a defensive investor own stocks? Graham gives 4 practical rules. First, diversify, but don't overdo it. Aim for at least 10 different issues and keep it under about 30. That range gives real diversification without turning the portfolio into an undifferentiated slush. Second, pick large, prominent companies with conservative finances. Those words sound fuzzy on purpose, but Graham suggests concrete thinking. A company should be big in its industry, well-known, and financed conservatively. For an industrial company, common equity should be a meaningful part of capitalization rather than debt. Third, require a long record of continuous dividends. Graham even suggests using the year 1950 as a benchmark, meaning the defensive investor should favor firms that have paid dividends consistently for about 20 years. Dividends matter because they show both earnings discipline and shareholder orientation. Fourth, limit how much you'll pay. He recommends not paying more than 25 times average earnings over about 7 years, and not more than 20 times earnings for the last 12 months. That rule effectively excludes most of the growth stock crowd, which often sells at much higher multiples. Graham is perfectly aware that this will ban many popular companies, but his point is that paying a sky-high price converts a promising business into a speculative bet. Graham then digs into growth stocks. He defines a growth stock as one that has raised per-share earnings much faster than the market and is expected to continue doing so. IBM is the classic example, and it rewarded early buyers handsomely over long periods. But Graham points out a crucial danger. Even the best growth stocks can fall dramatically, sometimes losing half their value within months, as happened to IBM in 1961, 1962, and again in 1969. Texas Instruments is another cautionary tale. It rose from tiny levels to spectacular heights in a few years, but then earnings and price collapsed sharply. The lesson is that growth stocks carry special vulnerability. The defensive investor is better off with solid, somewhat unpopular companies that trade at reasonable multiples. On portfolio maintenance, Graham is practical. Have your list checked once a year by a reputable advisor if you need help, but be wary of frequent churn. If you started with a competent selection, you probably won't need many changes. He endorses dollar cost averaging 2, the monthly purchase plan, as a sensible, low-stress way to build equity over time. Historical tests show it works well because it takes the timing pressure off and forces you to buy into weakness and trim exposure when prices are high. Graham emphasizes that your personal situation matters. He gives 3 scenarios: a widow with $200,000 to support her family, a successful mid-career doctor saving steadily, and a young man saving a modest amount each year. The core allocation advice is similar across them if they adopt the defensive stance. Keep a balanced mix of first-rate bonds and large dividend-paying stocks. But temperament, cash needs, and life events should influence where you land in the 25 to 75% stock band. Crucially, Graham does not say your age determines everything. Instead, he says assess your financial needs, job security, family obligations, and emotional tolerance for market swings. Graham also clears up confusion about the word risk. Many people use it to mean any price fluctuation. Graham insists risk should mean the real danger of losing principal, either because you are forced to sell at a low price, or because the company's fundamentals have deteriorated, or because you paid too high a price to begin with. In that sense, a well-selected basket of common stocks is not inherently riskier than other good investments, even though their market prices will swing. After the brutal bear market around 2000 to 2002, many investors felt burned and want nothing to do with stocks. This is actually not justified, as the crash removed some of the speculative froth and made stocks more reasonable for long-term owners. It also warns against lazy interpretations of buy what you know. Seeing a crowded parking lot or loving a product does not replace financial analysis. Overconfidence and home bias, piling into the company down the street or the employer's stock, have wrecked many retirement plans. Practical modern advice maps neatly to Graham. You can implement a defensive stock allocation cheaply with index funds or low-cost brokers. Dollar-cost averaging into broad index funds, rebalance on a schedule, and keep your allocation within your temperament and life needs. Art. If you lack time or willpower, use index funds and let them be the core. If you want to pick individual stocks, stick to Graham's rules. Big, profitable, dividend-paying, conservatively financed, and reasonably priced. And always keep at least 10 holdings.